Welcome back, Adem. Waiting to hear from you. I'm asking you to unmute.
Sorry about that. How you
Oh,
doing?
there you are. How are you, buddy?
Doing good. How have you been?
Rocking
Oh,
and talking to famous people, and got to talk to one of a guy I admire, Jack Schwager, at our summit over the weekend, and um,
yeah, I
hoping
loved
one
his
day
books.
to be an unknown wizard. I told
hmm
him that after his book gets out there, those unknown wizards will not be unknown anymore. So anyway, do you remember how to share a screen here? It's that
Yeah.
green, yeah, that green share screen. How are things in Arizona, bro?
It's the weather's getting better, but
Yeah, yeah, I
the
know. I live there.
Corona had a pretty big spike over the
Yeah,
last few months. So pretty much just trying to
hang home.
rebound from that.
Yeah. Okay. This is a look at your letter, right, buddy?
Yeah, this is just on my page, but I was
All
just
right.
looking
Well,
at
okay.
some.
I think it's a great. Are you going to talk about the corporate bond market? Because LQD, I'm following it. And um, before we get going, there's two stories. Like when the Fed came in and the bond markets all locked up,
hmm
and the Fed. Some people think the Fed came in and bought corporates, and some people said big rally we had, that big recovery was all jawboning. Um,
hmm
which was it?
Well, I know the Fed started buying corporates in May, but you know, it wasn't
Big?
enough. Yeah, in my opinion, it's all forward guidance. It's the idea that they say something that the market prices it in, which is
Okay.
probably the Fed's best tool, which we can
Yeah.
expect to hear more about. But what the downside from forward guidance is, and I'm sure you've noticed that when they make promises or they say, "Hey, we're gonna, get 2% inflation," or, you know, the bond market's safe, or et cetera, et cetera, and then it doesn't live up to expectations, the market reprices that very fast.
Okay. All right. So, what do you want to talk about today? You want to stay on this and look at some, tell us what you're advising your subscribers to do in this pretty difficult environment.
So
Um,
yeah, I
Go
was
ahead.
last time we spoke, I was telling you I really liked uranium, and it's gone up about 30% year to date, but I think it has more upside with the supply cutoffs happening. I know demand hasn't really been recovering as much as people expect, and I think that it's not going to continue expanding globally. I mean, if you just look at like euro area deflation, they just had deflation for the first time in years. China's exporting a ton of deflation with their cheap producer prices, which is pushing prices, globally downwards. I think you're going to see oil lower with because you have the marginal producers, the U.S. and frackers are starting to turn back on production rapidly, and then Russia and Saudi Arabia need, since they have nationalized oil, they obviously don't have the luxury of like a market economy. They have to produce oil to generate their government revenue. So
Okay.
I think fracking on the short side of oil, I'm looking back on that, like long dated out of the money puts. I'm just trying to see which ones are, cheap relative to the upside. And I think, I don't know, I think with the economy right now, I think with fiscal stimulus talks, I'm not sure. I think that, what's going to happen with that. I think tonight the debates are going to be really interesting, but I think the market's been pricing in this inflationary recovery. The US dollar has dropped like almost 10% year to date on,
What do
assumptions
you think?
that,
We've had a little recovery in the dollar. A few weeks. Dixie bottomed around 91.80, got into the mid 94s. If you're in the deflation camp, would I be correct to think that you're a dollar bull and that this dollar weakness could completely reverse itself?
yeah, actually, so on, I made a case last year for both my personal belief is the dollar's going to get stronger just because of the global dollar shortage. You see the Brazil real. I was just
Yeah.
looking at it, like rolling over. Like I'm looking at the chart, the 1 month right now starting to roll over. And then you have the ZAR, the South African rand, rolling over. The Turkish lira obviously rolling over year to date. So you have all these major emerging economies. India's not recovering, and it's their pandemic starting to get kind of out of control. The China economy isn't really. China's obviously the key. China's the global marginal growth producer. I was reading this BIS report saying that post 2008, China has pretty much carried global GDP 49%. So, when China sneezes, the whole world catches a cold,
It
that
used
kind
to
of
be
idea.
us, and now it's them.
Exactly. It used to be US and the developed markets, but like, a lot of analysts I see, they talk about like US growth or US inflation and, rebounding. But, you and I talked about this last time. You always have to look at the marginal change. And China and India are the only countries of size that are going to grow, 5 to 10% per year for this foreseeable future. You're not going to see America or the EU suddenly grow 5% on average, probably for the next decade. I mean, it could, obviously, but, I don't think that's likely. So for the
Okay.
kind of growth to happen, to actually carry worldwide, the world economy at this scale, it's going to, be China or India. So India has really bad infrastructure problems. I'm not, India's been like the holy grail that's supposed to like blossom for the last like
Yeah.
30 years, but they
Yeah, I've been
just,
hearing it my half of my life.
exactly. Yeah.
Yeah.
I mean, it has all the fundamentals in place, I guess, with the population, but
Yeah.
it's, the infrastructure is poor. China is the marginal growth engine. So, but the problem you
So
have with
if
that,
they ever have troubles, the whole globe's in trouble. And
exactly.
there are China bears, but you're constructive on China. Is that what I'm
So
gleaning?
I'm actually bearish on China in a way of they have a lot of problems structurally. Like for instance, they realized in 2016 when President Xi like took hold pretty much of everything. He pretty much came out and he said he wanted to tighten the shadow bank industry. And he said that
Okay.
there was a housing, remember the housing bubble in China? It was like
Oh,
rampant
the
growth. They
ghost
were just building
cities.
malls. Yeah, so in
Yeah.
the house prices that weren't even built, I'm sorry, houses and condos that weren't even built were being like bought. And I just saw an article on Bloomberg that like a firm that was like buying, or I'm sorry, selling properties that hasn't even built yet, put down big deposits for these homes being built. They sold out, but then the firm went bankrupt and they didn't like give the depositors their money back. So there's a lot of like,
Huh.
schemes, and they had wealth management products, WMPs, that Jim Grant from Grant's Interest Rate Observer in 2016 was warning against for the extra yield, but they were, kinds of like a Ponzi scenario. Um,
Wow.
so yeah, so with China, they're, it's a very hot money economy. They depend on inflows, so they have to keep their dollars up. But China has a ton of U.S. dollar debt maturing over the next couple of years. So that also, in my opinion, is going to keep the dollar pretty much afloat, higher, especially when you have all these emerging markets like Argentina recently. I don't know if you saw that they pretty much put on capital controls to prevent dollar outflows. But
Argentina, every few years there's a story like that.
yeah, so even with all their bailouts they've gotten over the last couple of years, they're still bleeding out dollars. Turkey did the blunder, and I'm half Turkish. My dad's from Turkey, so it pains me to see the, you know, idiocy going on there. But the central bank and Erdogan
Yeah.
refused to. No, well, recently they did. They had the central bank hike like 2 bips, but too little, too late. At this point, they've already bled through all their reserves. Um, so you have all these countries, emerging markets with a ton of dollar debt that need dollars to service these debts. I mean, they could go bust, but you know, I guess we'll see how that happens. But as long as U.S. dollar exports are slowing, there's not as much dollars getting trickling into the world because that's how we export dollars, either that and through debt. So with these rapid deficits, the idea of the inflation to before we go to that topic. So this chart I have up,
Yeah. The
like
dollar.
just talking about on the dollar, yeah, there's actually been the most shorts on the dollar, like speculative shorts, since 2017. So if the dollar keeps getting higher here, this could be a painful squeeze, and buybacks could send a dollar even higher. And I think as I think it all comes down to stimulus, because the Fed can print as much as it wants, but if there's no
Right.
money velocity, or if it's not getting into people's hands, they're just pushing rope. And I think we've learned this from Japan. We've learned this time and time
Yeah.
again. And I see a lot of analysts talk about inflation, but there's three types of inflation. I really want to stress this. And I think if you or your subscribers really like reading, there's a great book about this that goes all the way back to 980, and it goes over like the big waves of inflation, like that go last 100 to 150 years, and then like 75 years of deflation. It's called The Great Wave by the famous historian David Hackett Fisher. And
Wow.
it's a
I'm looking for
phenomenal
my
book.
pen. Yeah.
Yeah, it's called The Great
'Cause I
Wave,
want I
Price
want to write that.
Revolutions
I want to
and
write that
Rhythm
down.
of History.
Okay.
Yeah, it's a phenomenal book. And basically, it shows that throughout history, there's been 4 to 5, we're in the fifth one right now, major price revolutions where prices start rising slowly. And before I get to that, so there's the three types of inflation. You have demand pull, which is
Yeah.
if the population doubles overnight, and there's fixed amount of goods, prices start rising because of the extra demand. Historically, after there was periods of no war, so there would be like, there weren't like the wars going on in the medieval times, that men weren't dying as fast, and they were having children younger with women, so there was more mouths to feed. So during peace times, it would just lead to a demand pull inflation. Not a lot, but like usually prices would rise on average 1 to 2% a year. Then you have supply side inflation, which is called cost push. That's like we see with oil. If the price of oil collapses 50%, the gasoline price goes down, probably not 50%, but it drops. So it reflects the actual commodity. So like in the 70s, we had the oil embargo that sent oil through the roof. An oil supply shock didn't help, obviously, from the deep breaking of the dollar, and it really kicked inflation up. And then you have the big one, monetary inflation. And that's throughout history. They finally learned around like the 1800s that, so back in the day when prices were rising, the medieval leaders said, hey, let's just melt silver down from swords, add it into the, if people prices are rising, let's just give them more money. That just amplified the problem, though. So they finally realized that in the third price revolution that, hey, printing money or adding money doesn't really help. So
Okay.
the reason
I mean, didn't the Romans do that? I mean,
yes,
they went from, they would take a more valuable element out of their coins to eventually they became just kind of what, a non-ferrous metal nothing.
Yeah, and actually that happened in London before. I just read another phenomenal book by Sam Levinson, Money for Nothing, about the South Sea bubble and how Isaac Newton pretty much like revolutionized their print, because London was on the silver standard while France and everyone else was on the gold standard in the late 1600s. But there were so many wars that they had to keep financing it. There was heavy outflows from London, and then they adopted like a credit-based monetary system. It was still backed by silver, but they wanted to use credit, and people started using the paper like demands coin slips. But the point was that there was a bad outflow of silver, and they were coin clipping, so they had to go take all the silver, pull it back in, and remint it, and make it a new value. And they said in the book, like some coins were they were down like 70%. They were just like there was nothing left to them. So then but yeah, so those three types of inflation historically. So right now, I guess we'll just get to now that I see a lot of people like we've been saying like hyperinflation the last 10 years. Personally, I believe inflation is a psychological thing, like hyperinflation, because it's when people realize the money's losing money, they start freaking out, and then it's like reflexive, and it becomes a self-fulfilling prophecy. While you're ditching money, prices go fire, and it cycles out of control. But let's just go to normal inflation. So like the book, yes, we do have inflation, and I believe we have inflation, and I hate the idea of it, obviously, because it's stealing from you and I. It's a hidden tax. Right. But it's over a very small amount. It's not like when you and me are going to the grocery store today, we're like, oh, wow, prices have doubled since last year. Some products might because of supply issues, demand, but generally prices don't triple. But you and I can look back and go, hey, 20 years ago, or we hear from like our grandparents, like, oh, 40 years ago, I was able to get, 50% more. So that's like that kind of inflation I was talking about from the early ages. It's like 1 to 2%. And historically, David Hackett Fisher in that book shows that over about 70 years, that's when people start noticing like it's more than marginal. Like, hey, wow, like my purchasing power has really declined. And then there would be like a grain shortage, like a farm was flooded back then, or a war broke out. And it would send prices skyrocketing, and it would lead to horrible like civil wars. The Edward II was overthrown in England over it. The Florence Empire collapsed over it. The Medici Bank went bankrupt. Like all these throughout history, all these problems happened. And then what happens? A plague, or from the war, people would die. Plague would wipe out 20 to 30% of people, especially because people were going broke and they were starving. Having the plague didn't help because there was grain shortages, so they weren't getting any nutrients. Right. So then after all that, you would also have all this new marginal production coming online because people were like, hey, we need to get more farming. So they would clear new fields and they try to harvest more. But because of that, and then all that supply plus people dying from plagues, it would lead to a huge long period of deflation, which was like the golden years, where workers had like the actual increase in purchasing power, real rents went down, et cetera. So David Hacker Fisher ended up passing away, I believe, if I remember right. And he pretty much left off saying we're in that wave, and we're in the fifth wave right now, like since the 1900s. And with the central banks, we've seen the inflation, but today I see everyone talking about inflation, especially a lot of analysts. But when you look at the demand side isn't increasing, especially China is the marginal growth engine. Their consumer spending is weak. They're just doing barely enough. Since 2016, they're stimulating just enough, not to save the rest of the world. Like if you remember the 2015 China devaluation, a massive stimulus they did, they like bailed out the world. Same with 2008. Well, they're not doing that anymore. They're doing just enough to like not crash themselves, but they're not bailing out the world. And actually their finance ministry said, I read on Bloomberg today, that they're going to start normalizing policy soon. So it kind of shows that they're stepping away from excessive stimulus because they're trying to prevent, they have a debt bubble and they realize it. So the jury's out if they're going to be one of the first countries that are able to get out of a massive debt bubble without it, being heavily deflated, like Japanification. Yeah. I don't think they're going to have much luck with it.
Okay, so clarify something for Hackett's saying we're in the final wave, and to me, a wave 5. Okay, so a final wave has all kinds of implications of the ending of something and the beginning of something new. Talk us through this fifth wave, what's going to happen, and then what changes it.
So basically, yeah. So after World War II, a lot of people's lives were lost in World War II. So, and then you also the baby boomers. So you had a lot of demand pull inflation. And then in the 70s, like how Jim Rogers got famous betting on commodities, there was huge commodity shortages. So, but since then, so it led to higher inflation in the 70s and 80s. Thing was in the 80s, while Paul Volcker was tightening, the federal deficit was barely, I think it just hit $1 trillion at that point. So Ronald Reagan and, Congress had a ton of room to run fiscal policy, which they did, and they ran easing. The dollar was strong because of the monetary tightening, but they were able to offset it with huge tax cuts, the Reaganomics. Right now in today's economy, we already have record deficits. The Fed rates were already at 0 before this crisis came. I was reading this great report from the BIS showing that for over the last 100 years, for central banks to get any kind of marginal stimulus, they have to cut rates by 3%. So I think that's why the Fed was trying to get rates up to 3%. So the next recession we were in, they could have cut and try to get some kind of growth, but they weren't able to get it up. They barely got it to 2.5. So now they're at 0. They're probably going to try yield curve next. That's what Australia just started doing. You have all these countries, Japan's same never-ending problem with them. It doesn't matter what they print. But with the other way we were showing was, but the baby boomers now, so you had a lot of mouths to feed. So you had this 1950s all the way to the 90s, 2008 really, of growth. You had, inflation was going higher, not too high, but, above the 2% they wanted. It was, debt was growing, home prices increasing. Pretty much asset prices were growing faster than the debt. Well, after 2008, that changed. And now it's been heavily deflationary. You have tons of commodities have come online on the idea, like you and I were talking about earlier, that China and India are going to be these huge consuming nations. You had like Australia, Canada rally, all, oil, every commodity is like overproduced right now. And they're just most commodities. Then you have the demand side. And also you have on the supply side, you have technology, cutting prices faster. You have places like making their packages smaller, etc. So they're kind of able to offset costs. Then on the demand side, you have the baby boomers now retiring. That's taking demand out of the system. Not to mention they're going to start pulling their money out to live off their bonds and etc. So that hasn't really happened yet because people are trying to save. But that is a threat for the deflation. World demographics are on the deflationary trend. You're having more deaths than births. Even in China, they're having like a record 300 million workers leaving the workforce in the next like 3 years. It's like a huge amount. So you have on the demand side more also with this pandemic, how much trillion in GDP globally, not just the US. Like if you look at every country, it was like negative 20% annual GDP drops. So you had a huge chunk of demand loss compared to what the government stimulated. Even if they gave everyone $1,200, I mean, the losses were still greater than what they tried to supplement. So those are the two inflations. So my thing is this. You have two out of the three. You have demand and supply, the only that are deflating. Then out of the third inflation, monetary, the Fed's been printing like crazy. So if you have the Fed printing, but two out of the three are deflating, you have a deflationary kind of pressure, overwhelming monetary. Now, the idea is and this next wave, right now it's deflationary except for the monetary, because also with debt is very deflationary. We have a ton of debt in the system. Now, if the Fed is telling fiscal, like they're going to Congress, I'm sure you've seen, they go there and they're like, you guys, just get it together, agree, do a damn stimulus. We got you. We're going to print the dollars, buy your bonds. Like, don't worry about it. Like, just do it. And now they can't agree. That's always what happens. Like, even back to the Rome days, it just, the both sides can't agree. Exactly.
Yeah.
So until they get some kind of stimulus going, which I don't know if it'll even be enough. I mean, we'll see. But until they can get something going that can actually tip one of the two, demand side or supply side, into the inflationary trend, I just don't see how you're going to have above trend inflation, which I personally like. But as like huge debtors and corporations, that's not good. And I think the longer this deflationary trend goes on, you're going to see bankruptcies increase. Like I just was reading this article I have, New York region sees 40% bankruptcy surge. New York is obviously a staple of America, and the city is pretty much under chaos at the point. So I just don't know what's going to happen with the economy going forward. But I do think that there's going to be more deflation than inflation. And I think the euro's learning that the hard way right now. And with the Fed putting rates to zero, I'm sure you've noticed that bank stocks have completely collapsed because it crushes bank margins. So I hope the US doesn't go to negative rates, because we've seen it doesn't work, and it's just going to kill our bank system.
Okay. How are you positioning yourself into this Hackett's fifth wave? Because you brought up famine, and that created people bidding up everything and worried about their currency because of what they were paying for food and the implications of it. There are a lot of things happening in our grain belt that are threatening supply, and China coming in and buying beans. We have one of the smallest carryovers in beans that we've had in a long time. So another bad crop year could cause food inflation.
Yeah, you're absolutely right. And last year we saw that with meat prices. It was just one African swine flu tipped.
Right.
That was a big trade I did. I did on like a meat play and JBSA in Brazil. I'm still looking at that now for the next meat issue, but they're starting to rebuild their hog supplies. But that doesn't take away the threat, especially with African swine flu. The contamination of that disease is crazy, how fast it can spread. And if it even get a hint of it from one farm, they have to go slaughter all the pigs.
Isn't that what happened in China? I mean, like 75%?
Yeah,
they had to get rid of.
They culled pretty much their entire pig population. It was terrifying. So yeah, you are right. Like, so after the 70s, when food prices went up, it brought on a ton of marginal production, because people, like, sugar prices went up like 1,000%.
Yeah, and I remember
so
40% sugar.
Yeah, so sugar, farmers were like, hey, I'm going to become a whatever sugar entrepreneur. They came on, they have the capital cycle kick in, and they start trying to soak up the profits from the higher sugar price. But now all that extra supply builds up for years. And like we had big grain storages in the early 2000s, but now they're depleting. So that's why I've been reading like Jim Rogers, and he's saying he's getting bullish on commodities, mainly because, like you were saying, the storage of our commodities are depleting. They're in like a negative trend. So that could be something, obviously that could tip
On the
scales on the
horizon.
inflationary side. I mean, we saw what
Yeah.
coronavirus did. Just from the demand pull inflation, we saw supermarket inflation increase. That's the only thing that's actually been on our CPI. Like everything else has been going down. The only thing that's been going up was grocery stuff, just because of coronavirus. So I want people
Yeah.
to understand that those three types of inflation all work against each other. They're in their own reflexive feedback loops, pushing against each other. And I think if we get one more, if the Fed is easing and the other two are deflating right now, it's marginally deflationary. But if just a big oil glut happens, oil like embargo or any kind of main commodity like food, especially shortage happens, or a couple crop failures, or pig or meat. Like I just saw in the U.S. they were culling a lot of pigs too that weren't being eaten, just wasting it.
Oh
So
yeah, yeah, yeah.
one thing like
Everything,
that could tip it.
milk, yeah. The farmers were crying because they kind of have an attachment to them. Um, what about when you talk about China and Hackett's fifth wave? What about war with China?
So yeah, war generally. So the unrest from the money issues usually lead to war, and it's always been kind of like, I'm sure you know the Keynesian things, like, hey, if we knock things down, we can rebuild. War has always been a way to like kind of cull the population while at the same time it produces a lot of demand. And I don't mean that as, who knows if our leaders actually do that on purpose. I don't know, but just looking at it from a perspective, usually in times of like Great Depressions and
Yeah,
famines and unrest, it leads to upheavals. Usually it's another group overthrows, there's like a civil war and it overthrows the leading group. Like the Spanish Empire ended up collapsing from Napoleon in the early 1800s. He ended up ruining the Spanish Empire. And if you see what happened there, that was the French Revolution literally led to Napoleon, which led to the 7 coalitions. So it
you
could
are
happen.
really so well versed, well read, Adam. I could talk to you for hours,
Oh
and
yeah, I love
yeah,
reading.
really. So I'm gonna check out Hackett's book, and what a great chart on the dollar. And we have to wrap it here. So
Oh,
is the
of course.
best way? What's the best way for people to follow your? You're a student of history, and is your website the best place to go, or
Yeah,
Twitter, or
Twitter at Radical Adem, and if I'm
you're
on my
not that
site.
radical. You're just a thinker.
Yeah, I just it was from my
Yeah,
favorite anime,
all right.
Cowboy Bebop, the name Radical, so I just added it
Uh,
with my name. But I actually have a reading list on my website free that I have like a bunch of history books and everything that everyone's you know please check out. It's a lot of my favorite books. I'm going to update it soon for a lot of books I've added, but every book I read that I like, that I find is practical wisdom, definitely goes on there.
all right, Ed. Well, I tell you what, Adam, my trading warrior brother, we'll have you back. Uh, you're one of my regulars now. So,
I appreciate it a lot, and thank you for having me. Sorry for the long-winded ramble.
no, it gave us lots of food for thought. In fact, so much I may have to eat a Tums or two to digest it all. All right, buddy.
Glad
So,
to hear.
everyone, check out Adem and his work, and if you're interested, he's a student of history, and you have to be aware of history because things don't always repeat, but they usually at least rhyme. So that's going to be a wrap for today, Turnaround Tuesday, and I guess we'll see everyone tomorrow, hopefully. And don't just count your, I don't know, your grain, your stockpile of anything, your portfolio, count your blessings, and you're welcome, Sam. Forex Gal, Brock, and thanks to Dem once more, and we'll see you all tomorrow.
Great. Thank you for
Okay.
having me.
All right. Thank you again, Adem.